with us on ET Now, and we are continuing our focus on the earnings season. Well, it's been a decent Q1 for Greenpanel Industries. In fact, Himanshu Jindal, the CFO of Greenpanel Industries, is now joining us. Mr. Jindal, good morning. Thank you for joining us on ET Now. Mr. Jindal, your numbers do look were good in FY27 with a revenue growth of more than 6% and margins have also seemed to improve. What really were the triggers behind this growth, and what is the top line and margins outlook for FY27?
So thank you for having me. Good morning to you all. So see, our retail side of our business, both on the MDF and the ply side, continues to do well. The retail MDF has been growing consistently over the last 4 quarters now, and this quarter also was no different. So we've grown our volumes by 20% YOY. Ply too has clocked a double-digit growth in volumes. On the other hand, the less value-accretive businesses or the revenue streams, which is OEM and exports, have been impacted in Q1. These are largely price-sensitive segments, and there has been more uncertainty on cost at the moment. Therefore, committing price and volumes was a little challenging. OEM degrew by 14% YOY, while the export was 0 in Q1. Given our own historical run rates in the last year, Q2 to Q4, I think we could have easily done another 25,000 to 30,000 on both of these. On the pricing front, as you're aware, we took a 15% hike in MDF in the last quarter in April. And given the uncertainty on chemical costs, we were more disciplined on our side in terms of the rollbacks, which some of our peers actually did. And this might have impacted some of our volumes for sure. On margins, you rightly said our gross margins and our operating EBITDA margins have all improved, thanks to the price increases, timely price increases. And there was also an effort on our side in terms of the timber mix and the fuel efficiencies and the power efficiencies kicking in. So despite a chemical cost increase, you see what you see in our results.
All right.
On the guidance, sorry, please.
Yeah, sure. No, I was just wanted to know about your operating EBITDA margin, improved from 4 to 10.3% in MDF. How much of this improvement is structural through pricing and efficiency, and how much was aided by lower cost inventory?
See, very honestly, we took if you look on a YOY basis, there was 7.5% coming in via pricing. If you look at our gross margins have gone up by 6%. So there is definitely a play of pricing coming in. But yes, we lost something on chemicals, and very, very clearly we built it up more via the timber cost, the timber wood mix, as I've mentioned, and the power and the fuel efficiencies. To give you a split, whatever we lost on chemicals was roughly around 6-7%. From an efficiency point of view, we got 1.5% floating into our contribution margins.
Now, with MDF domestic realization up about 7.4% YOY, how much further pricing power do you see? And are you seeing any resistance from dealers or customers to recent price hikes?
See, there has been a fair amount of rollback already, Q1 itself, in fact. Yeah, so we reacted a little late. But if you look at it otherwise, there is very aggressive at discounting continued by our peers. And we are reacting wherever we need to. On the cost front, things are very, very uncertain, to be honest. The chemical costs have come down from the peaks that we saw. But now, even today, the costs are very volatile, very fluid. On the other hand, so this is costs and margins and, pricing environments. But more importantly, I think the demand side is holding up. Yeah, I talked about our retail volumes. Very, very clearly, see, MDF is a homogeneous product, very value-accretive product economically. And therefore, the penetrations that we can have, is astronomical. Yeah. So I think, between all the wood panel segments, I think MDF is very clearly a choice from a consumer point of view. So that's holding on. But given the macro environment on costs and pricing, I think guidances are becoming challenging for sure.
Sure. Now, talking about export sales, I mean, in Q1 FY27, we did not see anything due to the ongoing war in the Middle East since March 2026. Now, how it has impacted to your revenue and how do you see exports in the coming quarter now?
See, Jan said when I sold via exports, we were running at a run rate of roughly 8 or 9,000 cubes a month. Yeah. So you can, you can very well figure out, what I lost in Q1 on a monthly basis or on a quarterly basis. The underlying problem is obviously chemical costs. The underlying problem is also container freights. So whatever we were paying earlier, pre-war, that's kind of exploded now. It's almost 8x even today in terms of the container freights. Coming to what can we expect, I think, gradually things should improve. With normalcy setting in the Middle East, you should see volumes coming back. But it's going to be a graded thing. It's not going to be unlike what happened last year. Maybe the first 2-3 months are going to take some more time for volume build-up.
Mr. Jindal, appreciate your joining us on ET Now. Thank you very much for sharing your outlook with us.